Hello and welcome! Today's housing market feels confusing. Rates are high, prices are stubborn, and everyone is asking the same question. Where is this all going? So instead of guessing, we built a full economic analytics system. A systems breakdown of housing, commodities, labor force participation, trade, and global currency pressures, namely the BRICS, all working together. And what we found is dramatic. The forces shaping your mortgage rate, your home value, and your financial future are bigger, more interconnected, and more predictable than most people realize. Let me show you what the data is really saying. This first chart shows how the major macro forces in our economy move together, or in some cases, against each other. There is a significant and direct correlation between trade and housing. Housing and commodities also move in the same direction. Commodities and labor move in the opposite direction. But labor and global currency pressures, they pull apart. This matters because when these relationships tighten or break, the mortgage market reacts. These statistically significant macro correlations are the fingerprints of economic stress. And right now, they're telling us the system is under extreme tension. Next, the BRICS currency shock. This orthogonalized or statistically independent impulse response function chart shows what happens to global commodities when BRICS currencies strengthen. The response is immediate. Commodities jump. Why does that matter for you? Because commodities feed directly into inflation. Inflation feeds into interest rates. And interest rates determine your mortgage payment. Recall in my previous video where I drew the seesaw analogy of rates and prices. A currency shift on the other side of the world can raise the cost of a home right here in the United States. This is the global chain reaction most consumers never see. Now look at this. When trade conditions improve, housing responds, and not just a little. The impact builds over time. Stronger trade flows means stronger economic activity. Stronger activity means more demand. And more demand means upward pressure on property prices. This is why, even with high rates, property values haven't collapsed. The trade engine underneath the economy is still running. This chart shows the heartbeat of the labor market versus the trade economy. Prior to the pandemic, we can see labor and trade converging. Then, labor force participation fell sharply during the pandemic, and it still has not recovered while continuing to trend downward. Trade, on the other hand, spiked and then stabilized while continuing to diverge from the labor market. This imbalance is one of the hidden reasons housing inventories are so tight in certain areas of the country. Fewer workers, fewer builders, fewer homes. But demand? Still strong. Finally, comparing asset classes. Housing versus commodities over time. Housing climbs steadily, almost relentlessly. Commodities swing wildly, as they should, being riskier assets than real estate. This tells us something simple but powerful. Housing is a long-run anchor. Strive for ownership. If this information was food, it would be a 9-course dinner. So thank you if you are still watching. Now, what does all this mean for you? The buyer, the homeowner, the investor, the professional. It means the market isn't random. It's not chaos. It's a system. And when you understand the system, you can navigate it with confidence. Rates will move, prices will adjust, but the long-term fundamentals of housing remain strong. And with the right strategy, you can position yourself ahead of the next shift, not behind it. This is how we turn data into clarity. This is the power of systems analytics. For more real-time analytics, or you want to dive deeper into the data for your area, reach out anytime. Thank you for watching, and please follow, like, and share our content.